If you were to invest just $450 per month for the next 30 years, then the average market return, you would have over $1 million invested in 30 years. And if you were to wait just slightly longer, let's say 40 years, you would have $3 million. Today we are talking about the power of compounding, and I will explain how you can get these insane returns too. So buckle up and enjoy this video. Hey value investors, how are you doing? My name is Stijn and welcome to my YouTube channel. I have included timestamps in this video so you can skip around and rewatch quite easily. And if you appreciate that effort, show your support by giving the video a like. Enough plugging, let's get into it. For this video we will be talking through a couple of concepts you need to grasp before you can get these insane returns we just talked about. And the first concept is compounding. And to illustrate this world wonder called compounding, I have prepared 3 charts. First, let's say you were to invest $1,000 at a 5% interest rate for 20 years. 5% doesn't sound like much, but it will grow quite steadily. And at the end of the run, you still end up with $2,653 or $1,653 in profits. Awesome. So this is the base case we will compare the other charts to. So second, let's say you were able to invest for 40 years, not 20. The metrics will of course still be the same, so $1,000 at a starting capital and 5% interest rate for 40 years. Now I want you to take a second to imagine what the returns will be like. Do you think the returns will be twice as much, since 40 years is twice as much as 20 years? Well, I can't predict the number you were thinking of, but the actual number is $7,040. So your profit now is $6,040, or almost 4 times as much as the base case, just by extending your time frame. And the third situation we'll look at is $1,000 invested for 20 years at an interest rate of 10%. So that's twice as much return rate as the base case. Again, try to predict what the return rate will be. Should it be twice as much as the base case, since 10% is twice as much as 5%? Well, anyways, this one comes in at $6,728, which is a $5,728 profit in just 20 years. Or again, almost 4 times as much as the base case, just by increasing your rate of return. So what have we learned thus far? Well, as we've just seen, to get wealthy through the power of compounding, there are 2 things that matter most: time and rate of return. Actually, the longer you can wait and the higher your rate of return over that time period is, well, those 2 factors will express themselves exponentially larger returns. Awesome. So you've just learned all about compounding, and hopefully you understand its importance for the everyday investor. What we'll now look at is how you can actually get pretty good returns consistently for a long time. Warren Buffett, arguably the best investor of all time, actually called this investment the best thing ever for most people. It is called the Standard & Poor's 500, or simply the S&P 500. For simplicity's sake, I'll explain it like this. 500 largest companies listed on American stock exchanges are gathered and all added in one basket. And then that huge basket of 500 companies is listed as one stock. It's called the S&P 500, and it actually looks something like this. Here you can see all the companies bundled up in the S&P 500. Every company is operating in different industries, has a different market cap, has a different weighting in the S&P 500. To summarize, the S&P 500 is extremely well diversified. Therefore, traditionally the S&P 500 is seen as low risk. And what's more, the average return of this bad boy is actually 10.9% for the last 50 years. And in my opinion, that's a pretty damn good track record. Now we are going to look at how you can actually invest in the S&P 500 and what I think is the most optimal way of investing in the S&P 500. Well, depending on where you live, what broker you use, etc., you can actually invest in an ETF which tracks the S&P 500. And I know this sounds pretty scary, but an ETF is just an exchange traded fund. So basically an ETF is just a fund which is traded on a stock exchange, and an ETF which tracks the S&P 500 only means that you're buying a stock that goes up and down just as much as the actual S&P 500 does. Awesome. And regarding brokers, the place where you can actually buy stocks, there are so many great brokers around the world. You just need to sign up with one which has a low cost fee structure. The Giro and Trading 212 are pretty good for Europeans, while Robinhood and Webull seem to be pretty good for Americans. Since we are also different with different backgrounds, I can't really help you too much on this front. However, on most brokers you can just type in the S&P 500 and you'll find plenty of results. results. For example, this is the list from Trading 212, and the Vanguard S&P 500 ETF looks pretty good. So here we can see that this stock is trading in pounds, but no worries, it still reflects the American S&P 500. And to find the fee structure associated with this specific ETF, we can Google this ISIN code. Also, just the name of the fund works as well. However, for this specific Vanguard ETF, we can see that the cost structure is 0.07% on a yearly basis. And that, as a cost associated with investing, is pretty reasonable in my opinion. Now we are going to talk about when you should invest in the S&P 500. And the way I'm going to show you is dollar cost averaging, or DCA'ing for short. However, you can do whatever you want. I personally do not care for whatever your investment strategy is. However, DCA'ing has been proven time and time again to work pretty damn good. So how does dollar cost averaging work? Well, it is quite easy, to be honest. You just buy in every month, every week, every quarter, whatever time frame fits you most. It doesn't really matter which time frame you use, you just gotta use the time frame that works for you. Personally, I would be DCA'ing every time I get a paycheck. What matters, however, is that you contribute often and that you invest as much money as you can. However, do not invest money you know you need in 1, 2 or even 3 years. Investing money you actually need to spend just makes you a bad investor. Always invest with a 5, 10 to even 20 year time frame. DCA'ing works because you buy in the S&P 500 whenever it's overvalued, but especially when it's undervalued. And because you do both, you get the average return of the market, which happens to be 10.9% in the long run. And that is because you're buying every single time like clockwork. And this way you are not speculating, you're not trying to time the market. Timing the market does not work. Actually, there isn't anyone which has been able to time the market consistently. So most likely you won't be able to time the market either. Statistically, the best stock market days in history are often right after the worst days. And if you were to miss just the best 10 days of the stock market in the last 15 years, again, which sometimes happen right after the worst days, well, then you would miss out on a lot of the gains of the stock market. Actually, according to this paper, you would miss out on 220% of the returns just by missing out on the 10 best days. So if you have a long enough time frame, you can just invest through dollar cost averaging. And if your time frame is long enough, your return will probably end up around the 10% mark, which is pretty damn good. Of course, there are plenty of other ETFs, indices or even mutual funds you can invest in to get pretty good returns. However, they will be outside of the scope of this video. Also, most of these options also have a way higher cost structure associated with it, and most of these options, even with a higher cost structure, only still return 10% per year on the long run. And remember, higher fees means lower actual returns. And when investing, actual returns is what we're after. Lastly, when should you sell? Well, the perfect answer would be never. However, that is not realistic. So I'm going to share my own rules regarding index fund investing. First, always invest with a 10+ year time frame. Second, only take out the money if you need it for a better investment or you simply need the money. Third, try to dollar cost average for the rest of your working life. And you can, of course, supplement SP 500 with other interesting ventures. For example, real estate or individual stock picking. And the fourth rule is never sell for a fear of a market crash. And if you're looking for a tutorial to invest in individual companies to potentially de-risk your investment but also potentially get higher returns, well, I do plenty of videos on promising companies that have plenty of margin of safety and a lot of potential upside. So if that interests you, consider subscribing to the YouTube channel. And let me know if you'll be interested in a series where I explain researching in individual companies. And I think that covers most of it for this video. I really hope you guys enjoyed this video, and if you did, please give it a like and maybe subscribe. Comment down below what you want me to talk about next, and I'll see you guys in the next one. Peace.